I'm 52 years old and I don't own a single bond. Now, if you've been around traditional retirement advice, that probably sounds reckless, maybe even dangerous. After all, aren't bonds supposed to protect you from those big stock market drops, especially as you approach retirement? Well, I'm going to tell you exactly why I've chosen to avoid bonds entirely and why you might want to rethink how you protect your portfolio as you get closer to your retirement date. Let's start with why most people own bonds in the first place. The logic is pretty simple. As you approach retirement, you can't afford a huge drop in your portfolio value because you might not have enough time for the market to recover. This is called sequence of returns risk. If you retire in a down market and you're pulling money out every month to live on, you can deplete your portfolio much faster than you ever thought possible. So the conventional wisdom says shift a portion of your money, sometimes 40%, 50%, or even more, into bonds. The thinking is bonds are less volatile, so they help smooth out those rough years in the stock market. It sounds reasonable, but here's the problem. Bonds are not the safety net they used to be. Interest rates are still relatively low by historical standards, which means bond yields aren't exactly exciting. Bonds can lose value if interest rates rise, and we've seen that in a big way over the past couple of years. Over long periods of time, bonds tend to underperform stocks by a wide margin. So by stuffing your portfolio with bonds just to feel safe, you're not only capping your upside, you're also taking on risks of your own. Inflation risk, interest rate risk, and the risk of simply not having enough growth to fund a long-term retirement. And here's the kicker. If you live into your 80s or 90s, which many of us will, your money needs to last 30 or 40 years. Bonds just don't have the growth horsepower to get you there comfortably. So what's the alternative? Instead of watering down my stock portfolio with bonds, I use something called a volatility buffer. Here's how it works. I keep 3 to 5 years worth of living expenses in a separate, safe and productive account. My personal choice is Index Universal Life Insurance, or IUL. Now you may be wondering if the IUL really is a viable volatility buffer alternative. If so, you may be interested in knowing that a recent study by no less a resource than Ernst Young showed that utilizing an IUL as a volatility buffer gives you far more income in retirement than by utilizing a traditional stock bond strategy. An IUL gives you safety from market downturns because it's linked to an index but has a floor that protects you from losses, potential for reasonable growth without the full downside risk of stocks, tax advantages, growth inside the policy can be accessed tax-free if structured properly. Think of it like a shock absorber for your retirement income. Let's imagine I'm already retired and living off my investments. My stock portfolio is cranking along, giving me the growth I need. Then bam, the market drops 30%. Most retirees would panic. They'd have to sell stocks at depressed prices to keep paying the bills, locking in those losses forever. But with a volatility buffer like my IUL, I simply don't touch my stock portfolio during the downturn. Instead, I draw my income from the IUL. While the market is down, my IUL isn't losing value. It's still safe and available. Then when the stock market eventually recovers, which it always has, I go back to taking withdrawals from my stock portfolio. This strategy means I can leave my stock allocation high, even 100% stocks if I want, right up to and through retirement, because I've got a safety net. Here's the key takeaway. The only reason most people load up on bonds is to avoid having to sell stocks at a loss during a downturn. But if you've already solved that problem with a volatility buffer, you've removed the need for bonds entirely. Without bonds dragging down your returns, your portfolio can grow more productively over the long run. And that extra growth can make a massive difference in the second half of your retirement. You're not just protecting against downside, you're maximizing your upside. There's another big advantage of using a volatility buffer instead of bonds: peace of mind. Knowing I have 3 to 5 years of living expenses in my IUL means I can watch the news during a market crash without that knot in my stomach. I'm not worried about having to sell low. I can ride out the storm calmly. That's worth a lot because in investing, emotions are often your worst enemy. The more you can take emotion out of the equation, the better your investment returns. Now, I'm not saying that everyone watching this video should avoid bonds at all costs. Everyone's situation is different. Your risk tolerance, your goals, your income needs. But if you're like me, someone who values long-term growth and wants maximum efficiency from every dollar, then building your own volatility buffer might be a better way to go. You get the safety you need for income stability without sacrificing growth. If this concept is new to you, here's how to get started. Figure out your annual living expenses in retirement, multiply that by 3 to 5 to determine your volatility volatility buffer target. Explore safe, productive vehicles like Index Universal Life to hold that buffer. Make sure your IUL is designed for maximum cash value growth, not for death benefit. This requires working with someone who knows how to structure it properly. Keep your stock portfolio fully invested for growth, knowing you can pivot to your buffer in a market downturn. I recommend 70% in a total US stock market index and 30% in a total international market index. So yes, I'm 52 years old and I have 0 bonds, not because I love risk, but because I've removed the need for them. My volatility buffer lets me ride out the bad years without touching my stocks, and that's the key to keeping my portfolio growing strong for decades to come. If you want to learn more about how to set up your own volatility buffer, head over to davidmcknight.com and I'd be happy to introduce you to a Powers Year advisor in my network that has been trained, vetted, and qualified personally by me. I'm David McKnight. I appreciate you watching, and I'll see you on the next video.